So let's talk about one of the most powerful yet beautifully simple concepts in all of investing. It's a single principle that can protect you from all the madness in the market and, maybe even more importantly, from your own worst instincts.
Okay, but before we get to the solution, we have to really understand the problem. I mean, what do you think is an investor's single greatest enemy? Is it a stock market crash, a recession, or maybe just a bad stock tip from your buddy?
Well, it turns out the answer, according to the father of value investing himself, Benjamin Graham, is actually much closer to home. It's us. Our emotions, our biases, our tendency to get swept up in what everyone else is doing, that's the biggest risk we face.
And that really gets to the heart of the problem, an investor's fear. It's the fear of losing money that drives all those emotional mistakes. It's what makes us so likely to make bad decisions at the absolute worst possible times.
You know, Graham had this great way of describing the market. He said it was like a pendulum, always swinging from this wild optimism, which makes stocks way too expensive, to this deep pessimism, which makes them way too cheap. The real danger isn't the market being irrational. It's our emotional reaction to it. We end up buying high when we're euphoric and selling low when we're in a total panic.
So, what's the fix? How do we protect ourselves from this emotional roller coaster? Well, believe it or not, the answer comes from a completely different field. Let's take a look at how an engineer thinks.
I just love this line from Charlie Munger, Warren Buffett's legendary partner. He nails it. He points out that engineers, they build in safety buffers as a fundamental rule. It's just what they do. But in finance, we often chase risk without a second thought.
Warren Buffett has this perfect analogy for this. When you build a bridge, you don't design it to handle the exact weight of the trucks you expect. No way. You build it to handle way, way more. That extra capacity, that buffer for unexpected stress, that is the margin of safety.
So when you boil it all down, a margin of safety is just a cushion. It's a buffer that protects you when things don't go according to plan, which, let's be honest, they rarely do. It accounts for bad luck, for miscalculations, and for the simple fact that we just can't predict the future.
Or think about it like this. You would never get on a plane where the engine parts are used right up to their absolute breaking point. That 2,500-hour cushion is what keeps you safe, even if there's a hidden flaw or the engine goes through some unusually rough conditions.
Okay, so an engineer's secret, a bridge. How does this actually apply to buying stocks? Well, it all comes down to understanding the crucial difference between two little words, price and value.
And this brings us to probably one of the most famous lines in all of investing, and it is the key to this whole thing. Price and value are not the same. Price is what the market tells you a stock is worth right now. Value is what the business underneath it all is actually worth.
See, the price, that's just a number. It's objective, and man, it can change in a flash based on the market's mood. The value, though, that's an estimate of a business's real long-term earning power, and it changes much, much more slowly. The margin of safety is the gap between the two. It's the discount you get when the price is way below the value.
And that right there is why this gap is so incredibly important. As the great investor Seth Klarman points out, paying $1 for $1's worth of value, there's no real advantage there, and it offers you zero protection if your valuation is even slightly off. But paying 50 cents for $1 of value? Now that gives you a huge cushion against being wrong. Look, this isn't just some fringe idea from a textbook. The concept of a margin of safety is the absolute cornerstone of the philosophy of the most successful investors in history. Benjamin Graham literally wrote the book on this. It's called The Intelligent Investor. Buffett famously calls it the best book on investing ever written. And he specifically says you have to read Chapter 20, the one titled Margin of Safety as the Central Concept of Investment. He says it's essential. And the cool thing is, Graham wasn't just talking theory. He had these really practical, common-sense safety checks. First, he looked for strong earnings to make sure a company could easily cover its bills. Second, he demanded low overall debt. And third, he insisted that the stock's earnings yield, which is basically what the business earns compared to its price, had to be way more attractive than the super safe return you could get from a government bond. And check this out. Decades after learning from Graham, Warren Buffett was still saying the exact same thing in his letter to shareholders. It's not just a principle. He says it's the cornerstone. It is the foundation that all successful investing is built on.
Okay, so what does this all boil down to for you, the investor? Let's bring it all together and focus on the one thing you really need to remember.
So what is the margin of safety? Well, it's your defense against a future you can't predict. It's the simple act of buying a business for less than you think it's actually worth. It's not about timing the market. It's about protecting yourself from a catastrophic, permanent loss of your money. It's about buying $1 for 50 cents.
And that's the key, right? This is so much more than a financial tool or a number on a spreadsheet. It's a mental model. It's the discipline that keeps your emotions in check, forcing you to be patient and rational when everyone else out there is being greedy or fearful.
So I'll leave you with this question. The next time you're thinking about buying a stock, ask yourself, are you building a bridge with a massive safety buffer, or are you just closing your eyes and hoping the traffic is lighter than expected? The answer could make all the difference.